There is a ghost in the machine of the stock market. It's a phantom that lives in the space between the lines of an annual report, in the quiet hum of a satisfied customer, in the frustrated sigh of a defeated competitor. It is the single most powerful force in business, yet it has no line item on a balance sheet. It cannot be modeled in a spreadsheet, and it will never appear in a quarterly earnings report. And for this reason, 99% of investors are completely blind to it. They stare at the numbers, the charts, the ratios, treating the market like a complex math problem, wondering why they can never seem to solve it. They are looking at the shadow on the cave wall, convinced it is the real thing. But a very small and very wealthy minority have learned to turn away from the shadows. They have learned to walk out of the cave and see the business for what it truly is, a living, breathing organism of human relationships. At the center of this elite group is Warren Buffett. And the secret he learned, the one that turned him from a brilliant numbers guy into a legendary business sage, was not a complex financial formula. It was a simple, almost rustic idea he borrowed from a little-known investing giant named Phil Fisher. The idea was called Scuttlebutt. It's a funny word, an old sailor's term for gossip or rumors, the kind of talk you'd hear around the water cask on a ship. But in the world of high finance, it is a weapon of immense power. It is the art of investigating a business not as an accountant, but as a detective. It means leaving the office, stepping away from the screen, and gathering clues from the real world. It means talking to the people who live and breathe the business every single day. The customers who love the product, the competitors who fear it, the suppliers who depend on it, and the employees who build it. This process, this qualitative analysis, is the key to unlocking the truth. It reveals the durable competitive advantage, the economic moat, that allows a company to thrive for decades, compounding capital at astonishing rates. It is the only way to find the 100 baggers, the stocks that change your financial destiny, long before their greatness is reflected in the cold, hard numbers. The numbers tell you where a company has been. The scuttlebutt tells you where it is going. For the retail investor, for the serious student of business, for the entrepreneur who wants to build something that lasts, this is the master skill. Today, we are not just going to talk about this method, we're going to deconstruct it, piece by piece, and build a powerful mental model you can apply immediately. We will journey through the 5 fundamental pillars of Scuttlebutt, the 5 sources of information that will give you an informational edge so profound it will feel like you are seeing the future. This is not about stock tips. This is about a paradigm shift in your executive decision-making. This is the blueprint for developing a true CEO mindset, whether you're investing in a public company or building your own. This is the final promise of value investing, to see the world as it is, not as the spreadsheets say it should be. Our first pillar, the very bedrock of the entire Scuttlebutt method, is the voice of the customer. It is the ultimate source of truth, because a business, stripped down to its essence, is nothing more than a promise made to a customer. If that promise is kept, if it is cherished, if the customer feels it deep in their bones, you have the seed of an unassailable economic moat. If that promise is broken, no amount of financial engineering can save the enterprise. The numbers might look good for a year, or even 5, but the foundation is rotting from within. Most investors hear this and nod, thinking it's a trivial point. Of course, customers matter, but they don't truly understand the depth of this principle until they see it in action, until they witness how it can be the deciding factor between a catastrophic loss and a life-changing gain. There is no better illustration of this than one of Warren Buffett's earliest and most daring investments, a story that cemented his reputation as a financial prodigy, the saga of American Express and the Great Salad Oil Scandal. The foundational anecdote begins in the seemingly mundane world of commodities financing in the early 1960s. A small, unassuming company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation was in the business of trading, you guessed it, salad oil. Its president, a man named Tino DeAngelis, had devised a brilliant and utterly fraudulent scheme. Allied would borrow massive amounts of money from Wall Street lenders, including a major subsidiary of American Express, using its inventory of salad oil as collateral. The inspectors would come, dip their measuring sticks into colossal tanks of oil, and sign off on the loans. The problem was that the tanks were mostly filled with water. A thin layer of salad oil floated on top, fooling everyone. DeAngelis had created a phantom inventory, borrowing against assets that didn't exist. In November of 1963, the house of cards collapsed, the fraud was exposed, Allied Crude went bankrupt, and panic ripped through Wall Street. The lenders were facing catastrophic losses. The biggest victim was American Express. Its warehousing subsidiary was on the hook for an estimated $60 million in bogus warehouse receipts. In today's money, that's over $500 million. For American Express, a company whose entire net worth at the time was just $150 million, this was a potential death blow. The market reacted with brutal efficiency. The stock, which had been trading at $65 a share, was eviscerated. It plummeted to $35 in a matter of days. The talking heads on Wall Street declared that American Express was finished. Their logic was simple, quantitative, and completely wrong. They looked at the balance sheet. They saw a $60 million liability and a $150 million net worth. The math seemed clear. The company's equity was about to be wiped out. They assumed the business was functionally insolvent. This was the path of the 99%, panic, based on a single, terrifying number. But Warren Buffett, then a young, relatively unknown fund manager in Omaha, did something different. He didn't panic. He got curious. He knew the numbers looked bad, but his mentor, Benjamin Graham, had taught him that a stock is not just a ticker symbol, it's a piece of a business. And American Express had another business, a much larger and more important one, its travelers' checks and credit cards. Buffett's central question was not about the balance sheet. It was about the customer. Had the salad oil scandal, a fraud in an obscure warehousing division, damaged the trust that people had in the iconic American Express brand? If that trust was broken, the company was indeed worthless. But if it was intact, the market's panic was a screaming buying opportunity. So he began his Scuttlebutt investigation. This wasn't a desk job. He left his office and went to work. He visited dozens of banks in the Omaha area. He'd walk up to the teller and ask a simple question. Since the scandal broke, had they seen any decline in the sales of American Express travelers' checks? The answer, universally, was no. People were still buying them just as they always had. He then went to restaurants and hotels. He'd sit down with the owners and managers and ask them if customers were still using their American Express cards. He asked if they, the merchants, were still happy to accept them. Again, the answer was a resounding yes. They trusted Amex to pay its bills. In fact, many noticed something fascinating. They saw customers pulling out their green American Express card with a little extra flourish, a subtle signal of their status and creditworthiness. The brand was not just intact, it was a source of pride. Buffett talked to competitors, asking them if they were seeing a flood of customers leaving Amex. They weren't. The scandal was a Wall Street story, a footnote in the business section. For the average person, the American Express card in their wallet was still the ultimate symbol of financial reliability. This qualitative analysis, this on-the-ground investment research, gave Buffett a piece of information that was invisible to the spreadsheet jockeys in New York. He discovered that the real asset of American Express was not on its balance sheet. It was a phantom asset, lodged in the minds of millions of customers. It was trust. It was prestige. It was a powerful economic moat. Armed with this knowledge, he acted with conviction. He poured 40% of his partnership's capital into American Express stock, making it his single largest investment. It was a bet-the-farm move based not on a discounted cash flow analysis, but on conversations in restaurants and banks. Over the next few years, the stock quintupled. The salad oil scandal faded into memory, and the core business continued its relentless growth. The investment was a grand slam, launching Buffett into the big leagues of finance. It was a profound lesson. The most important questions about a business are often not answered by numbers, but by understanding human behavior. The power of Buffett's approach in the American Express case can be explained by a deep dive into the underlying psychological principle at play, the potent combination of the endowment effect and social proof. These cognitive biases are the invisible architects of brand loyalty, creating a fortress around a business that is nearly impossible to breach with marketing dollars alone. The endowment effect, first described by Nobel laureate Daniel Kahneman and his colleagues, is the human tendency to overvalue something simply because we own it. When a customer chooses a product or service, especially one that becomes part of their identity, they are no longer a neutral party. The American Express card wasn't just a piece of plastic, it was my card. It was a symbol of their financial success and sophistication. This sense of ownership creates an emotional bond. Any suggestion that the brand is flawed or that a competitor is better is perceived not as a rational argument, but as a minor personal attack. The customer's brain will actively fight against this information. They will seek out evidence that confirms their original decision was a good one, a classic case of confirmation bias. For American Express customers in the 1960s, the salad oil scandal was distant, abstract financial news. My card, the one that got them a table at a fancy restaurant or a rental car in a new city, was a tangible, positive part of their daily life. The immediate, personal experience of owning and using the card massively outweighed the remote, impersonal news of a problem in a division they'd never even heard of. They endowed the card with a value far greater than its mere utility, and this emotional investment made them incredibly sticky. Then, this powerful individual effect is amplified exponentially by social proof. This is the psychological phenomenon where people assume the actions of others in an attempt to reflect correct behavior for a given situation. When Buffett walked into a restaurant and saw other respectable-looking patrons confidently using their American Express cards, he was witnessing social proof in action. Each transaction was a small, public vote of confidence in the brand. It sent a signal to everyone in the room: this brand is safe, this brand is high status. People like us use this. This creates a self-reinforcing loop. The more people who use the product, the safer and more desirable it appears to non-users. The more it is used, the more it becomes the social norm. This is how a brand transcends being a simple product and becomes a piece of the cultural fabric. Competitors face an enormous hurdle. They aren't just selling a piece of plastic with a different logo. They are trying to break a powerful social convention. To switch from American Express to a new, unknown card wasn't just a financial decision. It was a social one. It meant stepping away from the in-group of established, successful people. This psychological barrier to entry is far more formidable than any technological or financial barrier. It's an economic moat built not of concrete and steel, but of human psychology. Buffett's Scuttlebutt method allowed him to see this moat directly. While Wall Street was analyzing the financial damage, Buffett was assessing the psychological damage. By talking to customers and merchants, he was taking a direct reading of the endowment effect and social proof. He found that the psychological fortress was completely untouched by the scandal. The customers still felt ownership, and the social signals were still strong. He understood that in the long run, this psychological reality was far more important than the short-term accounting reality. This is a crucial insight for any retail investor or entrepreneur. The loyalty and habits of your customers are a tangible asset. It is the raw material of pricing power and recurring revenue. Understanding the psychological triggers that create this loyalty is the first step toward building or identifying a truly great business. So how can you, as a retail investor or a business owner, replicate Buffett's process? How do you translate this story into a practical, repeatable system? This brings us to the applied mental model, which we can call the customer-centric moat assessment. This is your blueprint for conducting qualitative analysis on a company's most important asset, its relationship with its customers. It consists of 4 distinct steps. Step 1. Identify the true customer and the core value proposition. Before you ask any questions, you must know who you are asking about and what they are buying. This sounds simple, but it's often missed. For a company like Apple, The customer isn't just buying a phone, they are buying simplicity, status, and integration into an ecosystem. For a company like Costco, the customer isn't just buying bulk groceries, they are buying trust, value, and the thrill of discovery. You must articulate in a single, clear sentence what the company truly sells. For American Express, it was, "We sell trust and prestige to affluent consumers and businesses." Once you have this, you know what to test for. Step 2. Formulate your 5 core questions. These are open-ended questions designed to probe the psychological moat. They are not yes-no questions. They are: first, tell me about the last time you used this product or service. This question elicits a story, not just an opinion. It reveals the context and the emotion associated with the product. Second, what would you use if this product didn't exist? This is the killer question. If the answer is a shrug and, "I just use competitor," the moat is weak. If the answer is a long pause followed by, "Wow, I don't know, my life would be so much harder," you've found something special. Third, what is the most frustrating thing about this product? This helps you avoid confirmation bias. Even the best products have flaws. Understanding them gives you a balanced view and helps you spot potential threats. Fourth, have you ever recommended this product to a friend or family member? This is the Net Promoter Score question in disguise. A genuine, unprompted recommendation is the single strongest signal of customer love. Fifth, how does using this product make you feel? This gets directly at the emotional, identity-based connection. Does it make them feel smart, safe, powerful, creative? The emotional tag is often the strongest part of the brand. Step 3. Go to the digital water coolers. In the 1960s, Buffett had to physically walk into banks and restaurants. Today, you have an incredible advantage. The internet is a global collection of Scuttlebutt sources. Your job is to find the right ones. Don't just look at Amazon reviews, which can be easily faked. Go deeper. Find the dedicated Reddit subreddits for the product or brand. People there are passionate fans or equally passionate detractors. Read through months of posts. You'll learn the secret language, the common complaints, the beloved features. Look for specialized online forums. If you're researching a company that makes tools for woodworkers, find the woodworking forums. That's where the real experts share their unvarnished opinions. Watch unboxing videos and read 1 year later reviews on YouTube. Listen to the tone of voice. Is there genuine excitement or manufactured hype? These are the modern equivalents of Buffett's on-the-ground investigation. Step 4. Synthesize and score the moat. After gathering your data, you need to turn the stories into a judgment. Create a simple scorecard. On a scale of 1 to 5, rate the company on several factors based on your research. For example, stickiness. How hard would it be for customers to switch? Pricing power. Do customers complain about price, or do they seem to feel the product is a bargain even at a high price? Brand identity. Is the brand a badge that people are proud to wear or associate with? Net Promoter Signal. Is there a vibrant community of evangelists who love the product? By forcing yourself to score these qualitative factors, you translate the vague feeling of a great brand into a concrete assessment. This entire process is a core component of serious investment research. It moves you from being a passive consumer of financial data to an active business analyst. It's the first and most critical step in developing the CEO mindset that separates legendary investors from the crowd. To truly appreciate the power of this approach, we must examine its opposite. We must walk the antithesis, the path of the 99%. This is the path of the purely quantitative investor, the person we'll call the spreadsheet sentry. The spreadsheet sentry lives in a world of clean data and elegant formulas. Their conviction is derived not from human stories, but from numerical precision. They believe that if they can just build a complex enough model, they can decode the market. They see a company like American Express during the salad oil scandal, and their process is swift and decisive. They input the $60 million liability into their model. The model subtracts it from the company's book value. The price-to-book ratio explodes. The debt-to-equity ratio flashes red, and the model screams sell. For the spreadsheet century, this is objective truth. The numbers don't lie. They sell their shares, perhaps even short the stock, and congratulate themselves on their data-driven discipline. They feel smart, they feel safe. But they have made a catastrophic error. They have mistaken the map for the territory. They have analyzed the shadow on the cave wall with meticulous precision, failing to realize it's just a shadow. The path of the 99% is littered with the wreckage of companies that looked perfect on paper but had a fatal, qualitative flaw. Consider the rise and fall of Blue Apron, the meal kit delivery service. When it went public in 2017, the spreadsheets looked phenomenal. Revenue growth was explosive, shooting up from $77 million to nearly $800 million in just 2 years. It was a Wall Street darling, praised for its addressable market and disruptive technology. The spreadsheet centuries built their models, extrapolated the growth curve, and declared it a, quote, buy. But if you had done the scuttlebutt, if you had applied the customer-centric moat assessment, you would have seen red flags everywhere. Had you gone to the digital water coolers, the food blogs, the Reddit forums, you would have discovered a very different story. Customers complained about the immense amount of packaging waste. They found the recipes too complex for a weeknight. Most importantly, when you asked the killer question, what would you use if this product didn't exist? The answer was damning. They'd say, I'd just go to the grocery store. There was no stickiness. Blue Apron wasn't solving a deep, burning problem. It was a novelty. Customers would try it for a few weeks, lured in by a deep discount, and then churn. The company had to spend a fortune on marketing to constantly replace the customers who were leaving out the back door. The underlying business was a leaky bucket. The spreadsheet showed a beautiful, upward-sloping revenue line. The scuttlebutt revealed a disastrously low lifetime value per customer. The company was spending $300 to acquire a customer who would only generate $100 in profit before they canceled. The numbers looked great because they were buying growth at an unsustainable price. The spreadsheet centuries who bought at the IPO saw the value of their shares collapse by over 99%. The qualitative analysts who listened to the voice of the customer stayed a million miles away. This is the fundamental error of the 99%. They mistake backward-looking data for a forward-looking indicator. They see revenue growth and assume it will continue, without asking why it's growing. Is it growing because customers are fanatically loyal and telling their friends? Or is it growing because the company is lighting piles of cash on fire to acquire fleeting, unprofitable users? The numbers alone will never tell you the answer. Only the scuttlebutt will. Ultimately, this qualitative understanding must connect back to the financial reality of the business. The direct financial connection between a powerful brand built on customer love and a company's financial statements is concrete, measurable, and profound. The voice of the customer translates directly into dollars and cents in 3 critical areas: pricing power, customer acquisition cost, and recurring revenue. First, and most importantly, is pricing power. A company with a fanatical customer base, like Apple or See's Candies, can systematically raise prices year after year without a significant drop in demand. Their customers aren't buying a commodity. They are buying a feeling, a solution, a trusted brand. They are less sensitive to price changes. This ability flows directly to the income statement. It creates high and sustainable gross margins. While a competitor in a commodity business has to fight bloody price wars that erode profitability, the company with the brand moat can simply charge more. Over a decade, this difference in margin is the difference between a mediocre business and a cash-gushing compounder. It is the single greatest financial advantage a company can possess. Second is the impact on customer acquisition cost, or CAC. A business that grows through word of mouth from its delighted customers has a structurally lower cost of growth than a business that has to pay for every single new customer through advertising. Think of a company like Tesla. In its early years, it spent virtually nothing on traditional advertising. Its growth was fueled by the organic evangelism of its owners. This is a massive financial advantage. Every dollar that a competitor has to spend on Google Ads or television commercials is a dollar that Tesla could reinvest into research and development, building better factories, or expanding its charging network, further strengthening its moat. A low CAC means higher operating margins and a much more efficient and scalable business model. When you are conducting your investment research, a business that can grow its revenue without a corresponding explosion in its sales and marketing budget is a giant green flag. It's a sign that the customers are doing the marketing for them. Third is the predictability of revenue. A company with a loyal, sticky customer base has a much higher degree of revenue visibility. Think of Costco. The bulk of its profit comes not from the sale of goods, but from its annual membership fees. This is a stream of high-margin, recurring revenue from millions of loyal customers who have demonstrated a willingness to pay for the privilege of shopping there. This predictability is incredibly valuable. It reduces the risk of the business, makes it easier to plan for the future, and is prized by the market, often earning the company a higher valuation multiple. When Buffett found that customers of American Express were not abandoning their travelers' checks or cards, he was confirming the predictability of their revenue streams. He knew that the cash flow from the core business would continue, allowing the company to easily cover the losses from the salad oil scandal. So when you conduct your qualitative analysis, you are not engaging in a soft, fuzzy exercise. You are a financial detective, uncovering the hidden drivers of future financial performance. A happy customer is a leading indicator of a high gross margin. A customer evangelist is a leading indicator of a low customer acquisition cost. A locked-in customer is a leading indicator of predictable, recurring revenue. This is how the story connects to the spreadsheet. This is how you find great stocks long before the rest of the market wakes up. This is the first, foundational pillar of the Scuttlebutt method. The second great pillar of the Scuttlebutt method, a source of information as potent as the customer's voice, is the collective whisper of the competition. If understanding your customers tells you about the strength of your own fortress, understanding your competitors tells you about the terrain of the entire battlefield. A company does not exist in a vacuum. It is in a constant Darwinian struggle for resources, talent, and market share. By studying the actions, words, and even the silences of a company's rivals, an astute business analyst can gain an incredibly clear picture of its true competitive advantage. Often, competitors will inadvertently reveal more about a company's strengths than the company's own marketing department ever could. They do this through their envy, their frustration, and their grudging respect. Warren Buffett is a master of this form of intelligence gathering, and nowhere is this more evident than in his 1972 acquisition of See's Candies, an investment that would forever change his understanding of what makes a great business. The foundational anecdote of this pillar takes us to sunny California, to a beloved but seemingly unremarkable chain of chocolate shops. See's Candies was a family-owned business, founded in 1921, with a fanatically loyal customer base on the West Coast. When it came up for sale, Buffett and his partner Charlie Munger were intrigued. On the surface, the numbers were decent, but not spectacular. The business required very little capital to run, which was attractive, but it wasn't a high-growth technology company. It was, in their own words, a horse and buggy business. The initial asking price was $30 million, while the company had only about $8 million in tangible assets. This meant they would have to pay $22 million for something that wasn't on the balance sheet: goodwill, brand, what Buffett would later popularize as the economic moat. For Buffett, who was still deeply rooted in the classic Benjamin Graham style of buying companies for less than their liquidation value, this was a huge intellectual leap. He had to be convinced that this intangible asset was not only real, but durable. His investigation into See's Candies is a masterclass in competitive analysis. He and Munger didn't just look at See's financial statements. They started asking questions about the entire California candy market. They performed a thought experiment. They asked themselves, if we had unlimited capital, how could we destroy See's Candies? How could we create a competing brand, Buffett's luscious lollies, and take away their customers? They quickly realized it would be nearly impossible. They could build bigger, more modern factories. They could open fancier stores right next door to every See's location. They could even try to sell their chocolates for a lower price. But they couldn't replicate the one thing that truly mattered, the See's Candies brand that was lodged in the minds of generations of Californians. See's wasn't just selling chocolate, it was selling nostalgia. It was the box of candy you gave your sweetheart on Valentine's Day. It was the gift you brought to your mother on Mother's Day. It was a cultural institution. The act of giving a box of See's was a social ritual, a signal of good taste and affection. For a customer to switch to Buffett's luscious lollies, they wouldn't just be choosing a different product, they would be taking a social risk. What if their gift was seen as cheap or thoughtless? The risk wasn't worth the few dollars they might save. This insight was confirmed when they talked to other people in the candy business. The competitors. They heard the same story over and over. They heard about retailers who had tried to introduce their own private label boxed chocolates to compete with See's, only to see them fail miserably. They learned that even massive candy companies like Hershey's had struggled to make a dent in See's West Coast dominance. The competitors weren't just saying See's was a good business. Their actions, their failures, screamed it. Their inability to compete, despite having capital and expertise, was the most powerful evidence of See's impregnable moat. Munger and Buffett realized that the $22 million in, quote, goodwill was actually the most valuable asset the company had. It was a perpetual claim on the hearts and minds of its customers, which gave it immense pricing power. They bought the company for $25 million. Over the decades, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, requiring very little additional capital investment. It became Buffett and Munger's prototype for a perfect business, one with a deep, psychological moat that competitors simply could not cross. The lesson was profound. Sometimes, the best way to understand the power of a castle is to interview the armies that have failed to conquer it. The dynamic that Buffett and Munger observed with See's Candies is deeply rooted in the underlying psychological principle of competitive arousal and envy. When you are performing due diligence on a company, analyzing the emotional state of its competitors can be an incredibly powerful tell. Businesses are run by people, and people are susceptible to the same cognitive biases and emotional responses in their professional lives as they are in their personal lives. One of the most revealing of these is what we might call strategic silence. When a dominant company is discussed on an industry panel or in an earnings call, listen carefully to how its competitors talk about it. If they are constantly dismissing it, saying, "We don't really see them as a competitor," or "They serve a different niche," it can be a huge red flag for the competitor. This is often a coping mechanism. The dominant company is so powerful, so far ahead, that the competitor's only psychological defense is to pretend they aren't even playing the same game. It's the corporate equivalent of sour grapes. Their public dismissal is often a private admission of defeat. Conversely, when a competitor speaks with grudging respect about the market leader, it's a powerful signal. If the CEO of the number 2 company says something like, "Look, I have to hand it to them, their brand loyalty is just incredible," that is a piece of scuttlebutt gold. That CEO has teams of people whose entire job is to figure out how to beat the leader. If their honest assessment is that the leader's advantage is overwhelming, you should pay very close attention. Another psychological principle at play is in-group/out-group bias. Employees within a company develop a strong sense of identity and loyalty, the in-group. Competing firms become the out-group. This can lead to irrational behavior and biased statements. However, you can use this to your advantage. When an employee of a competing firm complains bitterly about the unfair advantages of the target company, they are giving you vital information. If they say, "We can't compete with their scale, they get volume discounts we can only dream of," they have just confirmed the existence of a scale-based cost advantage. If they lament, "Our engineers keep getting poached by them because they have more interesting projects," they have just validated the target company's reputation as an innovation leader. These frustrated whispers from the outgroup are often more honest and revealing than any polished press release. The key is to listen for the emotion behind the words. Is it fear? Is it envy? Is it genuine respect? These emotions are data. They are signals about the true power dynamics of the industry. The spreadsheet can tell you market share percentages, but it can't tell you that the number 2 player's CEO lies awake at night, terrified of the number 1 player's next move. That is the kind of qualitative edge that leads to long-term investing success. So how can you systematically gather and interpret this competitive intelligence? You need an applied mental model, a repeatable process. Let's call it the battlefield reconnaissance blueprint. It's a 3-step process for understanding a company by studying its enemies. Step 1. Map the competitive landscape. Your first task is to identify the true competitors. This isn't always as obvious as it seems. For Netflix, is the competitor HBO, or is it YouTube, video games, and even sleep? A broad definition is better. Group them into tiers. Tier 1 are the direct, head-to-head rivals. Tier 2 are the indirect or emerging threats. For each competitor, create a simple dossier. What is their stated strategy? Who is their target customer? What are their supposed advantages? This map prevents you from getting blindsided and helps you focus your research. Step 2. The earnings call eavesdrop. This is one of the most valuable and underutilized tools for the retail investor. Every public company holds a quarterly conference call where analysts ask the management team questions. You need to read the transcripts of the calls for your target company's main competitors. Don't just read them, search them. Use the find function, Control F, and search for mentions of your target company's name. What are the analysts asking the competition about your company? The questions themselves are data. They reveal what Wall Street perceives as the key threat. Then, study the CEO's answers. Is the answer crisp and confident? Or is it evasive and rambling? Do they dismiss the threat, or do they acknowledge it with respect? Does their tone change? Sometimes you can listen to the audio recording and literally hear the discomfort in their voice. This is pure Scuttlebutt gold, delivered to you on a platter. Also, pay attention to what is asterisk not said. If a competitor has a terrible quarter and blames industry headwinds, but your target company had a great quarter in the same industry, it tells you that the problem isn't the industry, the problem is the competitor. Step 3. Monitor the industry chatter. Beyond official corporate communications, you need to tap into the informal channels where industry insiders talk. This means becoming a reader of trade publications specific to that industry. These are magazines and websites that most people have never heard of, like American Machinist or Plastics Today. They are filled with interviews, articles, and gossip that reveal the true dynamics of the business. Another modern source is professional networks like LinkedIn. Observe the flow of talent. Are the smartest engineers and executives consistently leaving competitors to join your target company? That's a massive green light. Conversely, if there's a mass exodus from your company to a new, flashy startup, that's a serious warning sign. You can also monitor industry conferences. Often, presentations and panel discussions are posted online. Watching how executives from competing firms interact and talk about the market can be incredibly revealing. This entire blueprint is about triangulating the truth. The company will tell you one story in its press releases, the customer will tell you another, and the competitors will often unwittingly give you the third piece of the puzzle. When all 3 stories align to paint a picture of a dominant, feared, and respected business, you have found a potential candidate for long-term investment. Now we must consider the antithesis, the path of the 99%. This is the path of the disruptor devotee. This type of investor is constantly chasing the next big thing. They are seduced by narratives of revolution and paradigm shifts. They love a charismatic founder who promises to slay the giant and upend a sleepy old industry. Their portfolio is a graveyard of flashy startups that were supposed to be the Amazon of X or the Tesla of Y. The disruptor devotee's mistake is that they fall in love with the story of the challenger without ever doing the hard work of understanding the strengths of the champion. They commit the cardinal sin of competitive analysis. They underestimate the power of the incumbent's moat. A perfect example of this folly can be seen in the legion of companies that tried to take on Google in the search engine market. Over the years, there have been dozens of would-be Google killers. They often had impressive technology, slick user interfaces, and even brilliant founders. Investors poured billions of dollars into them. The disruptor devotees were all in, convinced that Google's dominance was about to end. But they failed to do the scuttlebutt. They failed to understand the nature of Google's competitive advantage. Had they done a proper battlefield reconnaissance, they would have realized Google's moat wasn't just its search algorithm. It was a multi-layered fortress. First, there was the brand. Google had become a verb. It was the default, ingrained habit for billions of people. This is a psychological barrier of immense height. Second, there was the scale of its data collection. Every search query was a piece of feedback that made the algorithm infinitesimally smarter. A new search engine was like a library with only a few books, while Google was the Library of Congress. The more people used Google, the better it got, which attracted more users, a virtuous cycle. Competitors who grudgingly admitted this would say things like, "We can match their algorithm, but we can't match their data." That was the key. The disruptor devotee, focused on the shiny new features of the challenger, completely missed the structural, self-reinforcing nature of the incumbent's advantage. They bought the story without checking the reality of the battlefield. As a result, they lost their capital, while Google's parent company Alphabet went on to become one of the most valuable corporations in the world. The lesson is critical for beating the market. It is not enough to find a company with a good idea. You must also analyze the competitive landscape and ask the hard question, can this company realistically win? More often than not, the giants of an industry are giants for a reason. They have deep, powerful moats that were built over decades. Ignoring the strength of those moats in favor of a seductive story of disruption is a reliable recipe for financial ruin. The financial implications of a company's competitive position are stark and immediate. The direct financial connection between a dominant market position and shareholder returns is the engine of wealth compounding. Understanding the competitive landscape through Scuttlebutt allows you to identify companies that are set up for decades of superior financial performance. The primary financial benefit of a strong competitive moat is the ability to generate consistently high returns on invested capital, or ROIC. ROIC is a measure of how efficiently a company is using its capital to generate profits. A company that can consistently earn returns well above its cost of capital is creating value. A company that earns returns below its cost of capital is destroying it. In a fiercely competitive industry, a process called reversion to the mean takes hold. If a company finds a new way to generate high profits, competitors will quickly pile in, copy the innovation, and compete away those excess returns until everyone is earning a mediocre return. It's like gravity. But a company with a durable moat, a beloved brand like See's Candies, or a scale advantage like Google, can defy this gravity. Their competitive advantage protects them from this process. It allows them to earn high rates of ROIC year after year after year. As an investor, your job is to find these rare businesses. When you hear competitors expressing their frustration and inability to compete, what you are really hearing is a confirmation of a sustainable high ROIC. Another major financial connection is seen in the company's growth strategy. A company in a weak competitive position has to spend all its energy and resources just defending its turf. It's constantly fighting price wars, responding to competitors' marketing campaigns, and struggling to retain customers. There is little money or management attention left for intelligent expansion. A dominant company, however, operates from a position of strength. Because its core business is a protected, cash-gushing fortress, it can use that cash to make strategic acquisitions, invest in long-term research and development, or expand into new markets. Berkshire Hathaway's purchase of See's Candies provided the cash flow that helped fund many of their subsequent investments. The profits from the candy business, protected by its moat, became the seed corn for an empire. When you analyze a company's competitors and find that they are all struggling for profitability while your target company is thriving, you are seeing this dynamic in real time. You are identifying a business that has the financial firepower to not only defend its position, but to grow it over time. This is the essence of long-term investing. You are not just buying a company's current earnings, you are buying its ability to reinvest those earnings at high rates of return for a very long time. The scuttlebutt gathered from the competitive landscape is the best tool you have for assessing the durability of that reinvestment runway. It is the second great key to unlocking the secrets of a 100-bagger stock. Our third pillar of the scuttlebutt method takes us away from the public-facing worlds of customers and competitors and into the hidden engine room of the business, the supply chain. The relationship a company has with its suppliers is a rich and often overlooked source of information. It is a direct indicator of the company's power, its operational efficiency, and its strategic importance within its industry. A company that is revered by its customers and feared by its competitors will almost always command an extraordinary degree of influence over the businesses that sell it raw materials, components, and services. This unseen power dynamic is a critical component of a durable economic moat, and learning to detect it is a crucial skill for any serious business analyst. For Warren Buffett, understanding this hidden leverage has been a consistent theme in many of his greatest investments, but perhaps none illustrate the principle more clearly than his long-standing love affair with the king of all brands, Coca-Cola. The foundational anecdote here is not about a single transaction, but about Buffett's decades-long analysis of Coca-Cola's business model, an analysis that culminated in a massive investment in 1988. By then, Coca-Cola was already a global giant, but Buffett believed the market was still underestimating the sheer power of its business. A key part of his conviction came from his deep understanding of Coke's relationship with its entire value chain, particularly its network of bottlers. The Coca-Cola system is a fascinating case study in supply chain dominance. The Coca-Cola company itself doesn't actually bottle most of the Coke sold around the world. Instead, it operates as a central brain. It manufactures the highly secretive syrup, the concentrate, and it masterminds the global marketing and branding. It then sells the concentrate to a vast network of bottling companies, which are often independent businesses. On the surface, this might look like a simple supplier-customer relationship. But through his research, Buffett understood it was a feudal system, with Coca-Cola as the undisputed king. The bottlers were the vassals. While technically independent, their entire existence was predicated on their relationship with Coke. They had invested billions of dollars in bottling plants, trucks, and distribution networks, assets that were essentially worthless without access to Coca-Cola's syrup. This created a profound power imbalance. The Coca-Cola company held all the cards. It could dictate the price of the concentrate, ensuring that it captured the lion's share of the system's profits. It could set quality standards and mandate marketing expenditures. The bottlers had very little negotiating leverage. Their best-case scenario was to be an efficient operator and earn a respectable but not spectacular return on their invested capital. The real magic, the incredible profitability, all flowed back to the mothership in Atlanta. Buffett's scuttlebutt approach would have involved talking to people up and down this chain. He would have talked to the bottlers themselves, hearing firsthand about their dependence on the concentrate. He would have spoken to the suppliers of the bottlers, the companies that make the glass bottles, the aluminum cans, the high-fructose corn syrup. He would have learned that securing a contract to supply a Coca-Cola bottler was a huge prize, one for which they would compete fiercely, driving down their own prices and margins to win the business. Everyone in the ecosystem understood where the power resided. This dynamic created a business of almost unimaginable quality. The Coca-Cola company had all the benefits of global scale without having to bear the costs and risks of owning the capital-intensive bottling infrastructure. It was a capital-light, infinitely scalable, high-margin royalty on a global habit. It was a toll booth on the world's thirst. When Buffett invested over $1 billion to buy 6% of the company in 1988, many observers were shocked. The stock market had just crashed in 1987, and here was Buffett making a huge bet on an old, established company. But Buffett wasn't buying the stock market. He was buying a business. And his qualitative analysis of its supply chain power gave him the conviction that he was buying the world's greatest business at a fair price. He understood that this hidden power dynamic ensured that Coca-Cola would be able to generate enormous and growing streams of cash flow for decades to come, a prediction that has been proven spectacularly correct. The power dynamic Buffett identified in the Coca-Cola system can be understood through the underlying psychological principle of dependency and the fear of loss. In any business relationship, the party that needs the other more is the one with less power. The Scuttlebutt method, when applied to the supply chain, is essentially a process of discovering who needs whom more. A supplier's psychological state is a goldmine of information. If a company is a supplier's single largest customer, accounting for 30, 40, or even 50% of their revenue, that supplier lives in a constant state of low-grade fear. The fear of losing that contract is an existential threat to their business. This fear can be leveraged, consciously or unconsciously, by the powerful customer. They can demand better pricing, more flexible payment terms, and higher quality standards. The supplier, terrified of the alternative, has little choice but to comply. This is a manifestation of loss aversion, the cognitive bias where the pain of losing something is psychologically about twice as powerful as the pleasure of gaining something of equal value. The supplier is not motivated by the potential upside of working with the powerful customer, but by the devastating downside of being cut off. This creates an enormous, and often hidden, cost advantage for the dominant company. Furthermore, the principle of reciprocity gets turned on its head. In a balanced relationship, two parties will engage in mutually beneficial give and take. But in a power imbalance, the powerful customer can demand concessions without feeling the need to reciprocate in kind. They might demand that the supplier hold extra inventory on their behalf, effectively pushing working capital costs onto the supplier's balance sheet. They might stretch out their payment terms from 30 days to 90 days, using the supplier as a source of free short-term financing. These are strategic advantages that are born from the psychological leverage one company has over another. As an investor performing due diligence, you can spot these dynamics. You can look for clues that a company is a customer of choice. Do suppliers brag about their relationship with the company in their own annual reports? Do industry journals write articles about how difficult but rewarding it is to meet the company's exacting standards? These are signals that the company is in the driver's seat. Conversely, if you discover that a company is heavily reliant on a single powerful supplier, for instance, a tech company that can only get a critical microchip from one manufacturer, you have identified a major vulnerability. In that scenario, the psychological principles are reversed. It is your target company that lives in fear of the supplier raising prices, experiencing production delays, or cutting them off entirely. This is a precarious position that the financial statements alone might not reveal until it's too late. To systematically analyze these hidden power structures, you need an applied mental model. Let's call it the supply chain stress test. This is a three-part blueprint for the retail investor to assess a company's position within its supply chain. Step 1. Identify the critical inputs. The first step is to understand what the company actually buys. For a restaurant chain, it's food and paper products. For a software company, it's cloud computing services and the time of talented engineers. For an automaker, it's thousands of components from steel and semiconductors to leather seats. You can often find clues about these inputs in the company's annual report, specifically in the risk factors section. The company is legally required to disclose if it has a heavy dependence on a single supplier. Read this section carefully. It's one of the few places a company is forced to be paranoid in public. Step 2. Assess the supplier's leverage. Once you have a sense of the key inputs, you need to figure out how much power the suppliers of those inputs have. Ask yourself a series of questions. Are the inputs a commodity, or are they highly specialized? A company that buys a commodity like wheat has thousands of potential suppliers and can easily switch, giving it the upper hand. A company that buys a patented, cutting-edge microchip from a single manufacturer is in a much weaker position. How fragmented is the supplier base? If there are hundreds of small, competing suppliers, the buyer has the power. If there are only 2 or 3 giant suppliers that form an oligopoly, the power shifts to them. A great piece of scuttlebutt is to try and find financial information on the suppliers themselves if they are public companies. Look at their customer concentration. If a supplier's annual report states that customer X accounts for 40% of our revenue, and you know your target company is customer X, you have just found a smoking gun confirming your company's dominant position. Step 3. Look for signs of preferential treatment. A powerful company often gets perks from its suppliers that others don't. Your job as a detective is to find evidence of this. One of the best places to look is the company's cash conversion cycle. This is a financial metric that measures how long it takes for a company to convert its investments in inventory and other resources into cash. A company with a negative cash conversion cycle is essentially getting its suppliers and customers to finance its operations. A classic example is Amazon. It often sells goods to a customer and collects the cash before it has to pay its supplier for those same goods. This is a massive competitive advantage, a sign of immense power over its supply chain. You can also look for qualitative clues in industry news. Are there stories about the company collaborating with its suppliers on new innovations? This can be a sign of a healthy, positive relationship. Or are there stories of the company squeezing its suppliers with aggressive tactics? While this can be a sign of power, it can also be a red flag that the company is creating long-term resentment that might eventually backfire. The goal of the supply chain stress test is to build a mental map of the flow of power and money. A great business is like a high point in the landscape, causing value to flow downhill from its suppliers and accumulate in its own coffers. Identifying this gravitational pull is a key part of advanced business analysis. As always, the value of this model is best understood by examining the antithesis, the path of the 99%. This is the path of the margin myope, an investor who is obsessed with a company's current profit margins but never asks why they are what they are. The margin myope sees a company with high gross margins and assumes it's a high-quality business, without ever investigating the sustainability of those margins. They commit the critical error of ignoring the company's dependencies. A cautionary tale here is the case of GT Advanced Technologies, a company that was, for a brief moment, a darling of Wall Street. In 2013, GT Advanced signed a massive deal to supply Apple with sapphire screens for its iPhones. The market went wild. The company's stock soared. The margin myopes looked at the potential revenue and projected huge profits. They saw a supplier that had landed the whale, the ultimate customer. But they failed to perform a proper supply chain stress test from GT's perspective. Had they done so, they would have seen that the deal was a devil's bargain. They were becoming almost completely dependent on a single notoriously demanding customer. Apple had all the power. According to later bankruptcy filings, the terms of the deal were incredibly onerous. Apple lent GT Advanced the money to build out its factories, but it retained immense control over the operations and could reject shipments for tiny imperfections, imposing massive penalties. GT Advanced was a vassal, not a partner. It was taking on enormous operational and financial risk to serve a customer that held all the cards. The margin myopes focused only on the potential upside, ignored this terrifying power imbalance. They didn't do the scuttlebutt to understand the lived reality of being a supplier to a giant like Apple. In 2014, the inevitable happened. Apple chose not to use the sapphire screens in its new iPhone 6. The deal collapsed. With no other significant customers for its sapphire production, GT Advanced was left with massive, useless factories and enormous debts to Apple. The company declared bankruptcy, and its stock price went to zero. Investors who had been captivated by the initial story were completely wiped out. This is the danger of being a margin myope. You see the what, the high margin or the big contract, but you don't understand the why. You don't see the fragile foundation upon which it is built. A proper qualitative analysis of the supply chain would have revealed that GT Advanced's position was incredibly precarious. It was a classic example of a company with a powerful customer, not a powerful business. The 99% see a big contract and cheer. The elite investor asks, who has the power in this relationship? The answer to that question is often the difference between profit and ruin. The direct financial connection between a company's supply chain power and its financial statements is one of the most direct and quantifiable links in all of business analysis. The qualitative insights you gain from the supply chain stress test manifest on the balance sheet and income statement in powerful ways. The most obvious impact is on the cost of goods sold, or COGS. A company that can command preferential pricing from its suppliers will have a structurally lower COGS than its competitors. This flows directly into a higher gross margin, which, as we've discussed, is a hallmark of a great business. But the impact goes far beyond that. As we saw with Coca-Cola, a company with a dominant position can structure its business model to be, quote, capital light. By franchising its bottling operations, Coke pushed the capital-intensive, lower-return part of the business onto its partners, while retaining the high-margin, high-return concentrate business for itself. This results in an incredibly high return on tangible assets. When you see a company with massive profits but a surprisingly small amount of property, plant, and equipment on its balance sheet, it's often a sign that it has mastered the art of leveraging its supply chain. The other critical area is working capital management. A company's power over its suppliers is most clearly visible in its accounts payable. A powerful company can dictate longer payment terms, essentially receiving an interest-free loan from its suppliers. If a company takes 90 days to pay its suppliers but its customers pay it in 30 days, it has a massive cash flow advantage. This is what contributes to the negative cash conversion cycle we mentioned earlier. This isn't just an accounting curiosity. It's a source of free money that can be used to fund growth without having to take on debt or issue new stock. It reduces the need for external capital and makes the business more self-sufficient and resilient. When you are doing your investment research, comparing the accounts payable days of a company to its competitors can be a simple but effective way to quantify its supply chain power. A company that consistently pays its suppliers more slowly than its peers is often the one that holds the power. By combining these quantitative clues with the qualitative scuttlebutt, you can build a complete picture. The story of supplier dependency explains why the gross margins are high, why the return on assets is superb, and why the cash conversion cycle is so favorable. This is how you move beyond simple number crunching and achieve a true, three-dimensional understanding of a business, the kind of understanding that allows you to invest with the conviction needed for beating the market. The fourth pillar of the Scuttlebutt method turns our investigative lens inward, from the external relationships with customers, competitors, and suppliers, to the internal engine of the company itself. A business can have a wonderful product and a dominant market position, but if its internal culture is toxic, if its management is dishonest or incompetent, or if its employees are uninspired, it is only a matter of time before the cracks on the inside become chasms on the outside. Understanding the human element, the quality of the people and the culture they create, is perhaps the most nuanced and most important part of qualitative analysis. It is an area where Warren Buffett has demonstrated a unique genius, often making investment decisions based as much on his assessment of character as on his analysis of financial statements. His acquisition of Nebraska Furniture Mart is the quintessential story of betting on people first and foremost. The foundational anecdote is a piece of business folklore, a story that perfectly captures Buffett's philosophy. It involves an indomitable Russian immigrant named Rose Blumkin, better known as Mrs. B. Mrs. B fled Russia in 1917, arrived in America unable to speak a word of English, and in 1937, with a $500 loan, started a small furniture store in the basement of a building in Omaha, Nebraska. Her business philosophy was simple and brutal: sell cheap and tell the truth. She worked with a fanatical intensity. Her business acumen was legendary, and she was a ruthless negotiator with her suppliers, buying in bulk and passing the savings on to her customers. Over the decades, she built Nebraska Furniture Mart into the single largest home furnishing store in the United States, a sprawling campus that dwarfed all of its competitors, who simply could not match her low prices and vast selection. In 1983, Warren Buffett, a longtime admirer and customer, decided he wanted to buy the business. The negotiation was as unconventional as Mrs. B herself. Buffett walked into her office and asked her to name a price. She thought for a moment and said, "$60 million. Buffett considered it for a moment and said, "Okay, I'll buy it." He asked for her financials. She replied that she didn't have any audited financials. Buffett didn't care. He asked for a contract. She said her word was her bond. The entire deal, for a $60 million company, was done on a handshake and a 2-page written agreement that Buffett drafted himself. He didn't do any of the traditional due diligence. He didn't have teams of accountants poring over her books or lawyers scrutinizing her contracts. Why? Because Buffett had already done a different, more important kind of due diligence over many years. His scuttlebutt was his personal observation of Mrs. B and her family. He saw how they ran the business with an owner's mentality, obsessing over costs, treating customers like gold, and working tirelessly. He saw a culture of absolute integrity and meritocracy. He wasn't buying inventory and a building. He was buying that culture. He was partnering with a manager he could trust implicitly. The story gets even better. After selling the company, Mrs. B, then in her late 80s, continued to work at the store every day, riding a motorized scooter through the massive showrooms. A few years later, after a dispute with her grandsons over her management style, she quit in a huff at the age of 95. She then crossed the street, opened a rival store called Mrs. B's Clearance and Outlet, and immediately started competing with the very business she had sold to Buffett, quickly turning it into the third largest carpet outlet in Omaha. Buffett, far from being angry, was delighted. He saw it as further proof of her incredible drive. He eventually bought her new company and brought her back into the fold. This anecdote reveals the core of Buffett's approach to the internal engine. He believes that outstanding managers with a fanatical, owner-like focus are the most valuable asset a company can have. A culture built on integrity, frugality, and customer obsession is a more durable competitive advantage than any patent or factory. His investment was not in furniture, it was in the unstoppable force of human will and sound character represented by Mrs. B. This focus on the human element is backed by powerful psychological principles. The underlying psychological principle at play here is the profound impact of organizational culture and the Pygmalion effect. Organizational culture is the collection of shared values, beliefs, and behaviors that determine how people act within a company. It's the way we do things around here. A strong, positive culture acts as an invisible hand, guiding thousands of individual decisions every day toward a common goal. A culture of frugality, like the one at Nebraska Furniture Mart, means that employees at all levels are constantly looking for ways to save money, not because a rulebook tells them to, but because it's part of their shared identity. This creates a cost advantage that is incredibly difficult for a competitor to replicate. You can't just install a frugal culture with a memo. It has to be lived and modeled from the top down for decades. The Pygmalion effect, also known as the Rosenthal effect, is the phenomenon whereby higher expectations placed upon people lead to an increase in their performance. A leader who genuinely trusts and empowers their employees creates a self-fulfilling prophecy. When managers like Mrs. B, or the ones Buffett seeks out for Berkshire's subsidiaries, are given autonomy and treated like owners, they rise to the occasion. They think and act with a long-term perspective, focusing on building sustainable value rather than hitting arbitrary quarterly targets. This is in stark contrast to the culture in many large bureaucratic corporations, where managers are incentivized by short-term metrics and constrained by endless rules. In these environments, the opposite of the Pygmalion effect occurs. Low expectations and a lack of trust lead to mediocre performance and a check-the-box mentality. Employees are not empowered to think like owners, they are trained to be cogs in a machine. This is why Buffett has always run Berkshire Hathaway as a decentralized holding company. He buys great businesses run by great people and then leaves them alone. He provides the capital and the encouragement, creating the perfect environment for the Pygmalion effect to work its magic. As an investor doing your own qualitative analysis, your challenge is to peek inside the company and assess its culture. Are employees treated as trusted partners or as interchangeable parts? Is the leadership focused on building something for the next decade or just for the next quarter? The answers to these questions are powerful predictors of long-term financial success. A company with a great culture has a tailwind that compounds over time, while a company with a poor culture is constantly fighting a self-inflicted headwind. Discerning a company's internal culture from the outside is challenging, but not impossible. It requires a specific applied mental model, a set of tools for the retail investor. We can call this the Cultural Detective's Toolkit. It's a three-pronged approach to investigating the human side of the business. Prong 1. The Shareholder Letter Litmus Test. The single most important document for understanding the mind of a CEO is the annual shareholder letter. You must go beyond the most recent letter. Read the last 10 or even 20 years of letters. This allows you to assess the consistency and character of the leadership. What are you looking for? First, transparency. Does the CEO openly and honestly discuss the company's mistakes and failures, or do they only talk about the successes? A leader who admits error is a leader you can trust. Buffett's letters are famous for this. Second, rationality. Does the letter explain the business and its capital allocation decisions in simple, clear language, as if talking to an intelligent partner? Or is it filled with corporate jargon and vague platitudes? Great managers are great communicators and educators. Third, long-term focus. Does the CEO talk about quarterly earnings per share, or do they talk about building the company's competitive advantage over the next decade? The language they use reveals their true time horizon. Prong 2. Triangulate with employee feedback. In the modern era, you have access to a vast amount of scuttlebutt from current and former employees. Websites like Glassdoor are a starting point, but they must be used with caution. A single negative review is just noise. You are looking for patterns. Are there consistent complaints about a toxic boiler room sales culture? Is there widespread praise for a supportive and mission-driven environment? Read reviews across different departments: engineering, sales, customer service. Does the company's public image match the internal reality described by its employees? You can also look for more subtle clues. Does the company have a high rate of employee turnover compared to its peers? This data is sometimes available in industry reports. High turnover is a major red flag, a sign of a sick culture and a huge hidden cost in recruitment and training. Prong 3. Follow the incentives. As Charlie Munger famously said, "Show me the incentive and I will show you the outcome." The way a company compensates its executives is one of the most powerful indicators of its culture and priorities. You can find this information in the company's annual proxy statement. Is executive pay tied to short-term metrics like the quarterly stock price, or is it linked to long-term measures of business performance, like growth in intrinsic value per share or return on invested capital? Are executives required to own a significant amount of company stock, aligning their interests with those of long-term shareholders? A compensation plan that rewards empire building or short-term financial engineering will inevitably lead to disastrous long-term outcomes. A plan that rewards rational, value-creating capital allocation is the hallmark of a company built to last. Using this three-pronged toolkit allows you to build a mosaic of the company's internal culture. It's not a perfect science, but it provides a much richer and more predictive picture of the business than the financial statements alone ever could. To highlight the importance of this, we must examine the antithesis, the path of the 99%. This is the path of the metrics-only manager, or the investor who worships them. This mindset believes that anything that can't be measured doesn't matter. It leads to the creation of corporate cultures that are optimized for hitting specific, narrow targets, often at the expense of the company's long-term health. A tragic and infamous example of this is the account fraud scandal at Wells Fargo. For years, the bank was lauded by Wall Street for its incredible cross-selling success. Its executives had set an aggressive internal goal for its branch employees: to open 8 different accounts for every customer. To incentivize this, they created a high-pressure sales culture with intense daily quotas and bonuses tied directly to the number of accounts opened. The metrics looked fantastic. The number of accounts per household, a key performance indicator, was climbing steadily. The investors who followed this metric, the metrics-only crowd, saw it as proof of a brilliant sales strategy and a growing business. But they failed to investigate the culture that was producing these numbers. Had they done the scuttlebutt, had they looked at employee forums or listened to the whispers from former employees, they would have heard stories of a toxic, high-pressure environment. They would have learned that employees were being pushed to the breaking point, forced to choose between hitting their quotas and acting ethically. The incentive system, which looked so powerful on a spreadsheet, was creating a moral disaster. The outcome was predictable. To meet their impossible targets, thousands of employees resorted to fraud. They opened millions of checking, savings, and credit card accounts and customers, names without their knowledge or consent. When the scandal finally broke, the fallout was catastrophic. The bank was hit with billions of dollars in fines. Its reputation, built over a century, was shattered. Its stock price languished for years. The executives who had overseen this culture were fired in disgrace. The metrics-only investors who had cheered the cross-selling numbers were decimated. This is the ultimate danger of ignoring the internal engine. A company's culture is its immune system. A culture focused solely on hitting a metric, with no regard for the underlying values, is like a body with a compromised immune system. It might look healthy for a while, but it is incredibly vulnerable to a catastrophic infection. The pursuit of a numerical target, without the bedrock of a sound culture, almost always leads to ruin. The true CEO mindset understands that culture is not a soft, secondary issue. It is the primary driver of sustainable success. The direct financial connection between a company's internal culture and its financial performance, while sometimes indirect, is overwhelmingly powerful over the long term. The qualitative strength of a company's human capital translates into hard numbers on the financial statements. First, a strong culture of ownership and empowerment leads to higher productivity and innovation. Employees who feel valued and are aligned with the company's mission are more likely to go the extra mile, to find creative solutions to problems, and to treat the company's resources as if they were their own. This translates into higher revenue per employee and better operating margins. It also reduces waste and inefficiency, leading to a lower cost structure. Second, a great culture is a magnet for top talent and dramatically reduces employee turnover. The costs associated with recruiting, hiring, and training new employees are enormous. A company with a stable, motivated workforce avoids these costs, which directly benefits the bottom line. Furthermore, the ability to attract and retain the best and brightest people is a self-reinforcing competitive advantage. The best people want to work with other great people, creating a virtuous cycle of talent acquisition. Third, and most importantly, is the impact of rational capital allocation. The primary job of a CEO is to decide how to reinvest the company's profits. A management team with integrity and a long-term owner-oriented mindset will make these decisions wisely. They will reinvest in strengthening the company's moat, make shrewd acquisitions at sensible prices, and return capital to shareholders through dividends or buybacks when they can't find better opportunities. A management team driven by ego or short-term incentives will do the opposite. They will engage in, quote, diversification, making overpriced empire-building acquisitions that destroy shareholder value. They will buy back stock at inflated prices to prop up the short-term share price. Over a decade, the difference between excellent and poor capital allocation is the single biggest determinant of a company's stock market performance. It is the multiplier on all the other aspects of the business. When Buffett bought Nebraska Furniture Mart, he wasn't just buying its current earnings stream. He was buying the certainty that Mrs. B and her family would continue to be brilliant capital allocators, wisely reinvesting the profits to grow the business's intrinsic value. This is the ultimate financial prize of a great internal culture. It ensures that the company's success will not be squandered, but will be compounded intelligently for the benefit of its long-term owners. We have now explored the four primary sources of Scuttlebutt: the customer, the competitor, the supplier, and the employee. We have learned how to gather intelligence from each of these domains. But gathering clues is only half the battle. A detective with a notebook full of disconnected facts has not solved the case. The final and culminating pillar of the Scuttlebutt method is the art of synthesis. It is the process of weaving the narrative, of taking all the disparate pieces of qualitative data and assembling them into a coherent, powerful, and investable story. This story becomes the foundation of your conviction, the psychological bedrock that allows you to act decisively and hold on for the long term, transforming a good idea into a life-changing investment. The intellectual father of this entire philosophy is, of course, Phil Fisher, and it is his own story that provides the perfect illustration of this final, crucial step. The foundational anecdote for this pillar is not about Buffett, but about his mentor in this style of thinking, Philip Fisher. Fisher was a pioneer of growth investing and literally wrote the book on the Scuttlebutt method, Common Stocks and Uncommon Profits, in 1958. One of his most legendary investments was in a small, innovative company called Texas Instruments in the 1950s. At the time, Texas Instruments was far from the household name it is today. It was a small player in the nascent semiconductor industry. Most of Wall Street was focused on the big, established electronics companies like RCA and General Electric. But Fisher began his Scuttlebutt process. He didn't just look at the numbers, he started talking to people. He talked to scientists at universities and government labs, asking them which companies were doing the most groundbreaking research in solid-state physics. The name Texas Instruments kept coming up. He talked to the engineers at competing firms, who grudgingly admitted that TI's research and development team was top-notch. He talked to potential customers in the military and industrial sectors, who were excited about the potential of TI's new silicon transistors to revolutionize their products. He delved into the company's culture, discovering a management team composed of brilliant scientists and engineers who were reinvesting every penny they earned back into research, driven by a passion for innovation rather than short-term profits. Fisher gathered dozens of these qualitative data points. Any single one of them was just an interesting anecdote. But he didn't stop there. He began to weave them together into a powerful narrative. The story was this: Texas Instruments was not just another electronics company. It was at the absolute forefront of a technological revolution, the shift to the semiconductor, that was going to change the world. Its lead was not just in its current products, but in its people and its research-driven culture. This culture of innovation created a feedback loop. The best scientists wanted to work there, which led to more breakthroughs, which attracted more customers and more profits, which could be plowed back into more research. This was a self-reinforcing engine of growth. This narrative, this synthesized story, gave Fisher a level of understanding that was completely invisible to the investor. Just looking at TI's modest current earnings, he understood the company's trajectory. Based on this story, he made a significant investment in Texas Instruments and, crucially, held on to it for years, even through periods of intense stock market volatility. The investment was a monumental success, multiplying his clients' money many times over. The lesson from Fisher's triumph is that the final act of the Scuttlebutt process is storytelling. You must transform your research from a collection of facts into a causal narrative that explains why the business is special and why it is poised for future success. The human brain is wired for this kind of thinking. The underlying psychological principle here is narrative bias. We are not natural statisticians. We are natural storytellers. We understand the world by constructing narratives that connect events and create meaning. A simple list of financial ratios is difficult for our brains to process and retain. A compelling story about a business, however, is memorable, persuasive, and emotionally resonant. When you perform the Scuttlebutt method correctly, you are building an information-rich, reality-based story about your investment. This story is not a fairy tale. It is a rigorous, evidence-backed thesis, and it serves a critical psychological function. It is the source of conviction. Conviction is the most precious commodity in investing. It is what allows you to buy a stock when everyone else is selling in a panic. It is what allows you to hold on to a winning stock for years, letting it compound, rather than selling too early. When the stock market crashes and the price of your investment is down 30%, the investor who owns it based on a spreadsheet model will panic. Their model is broken. Their quantitative signals are all flashing red. They sell at the bottom. But the investor who owns the stock based on a deep, scuttlebutt-derived narrative will react differently. They will ask themselves, has my story changed? Are customers still in love with the product? Are competitors still unable to compete? Is the culture still strong? If the answers are no, if the fundamental story is still intact, then the 30% drop in price is not a threat. It is an opportunity. It is the market offering them a chance to buy more of a wonderful business at a cheaper price. The narrative acts as a psychological anchor in a sea of volatility. However, narrative bias also has a dark side: confirmation bias. Once we have a story we believe in, our brains will actively seek out information that confirms it and ignore information that contradicts it. Therefore, a critical part of weaving the narrative is to constantly and actively challenge it. You must play the devil's advocate. You must specifically look for facts that would break your story. What is the single biggest threat to this business? What would prove my thesis wrong? This intellectual honesty is what separates a strong, reality-based investment thesis from simple wishful thinking. To put this all into practice, you need a final applied mental model. Let's call it the one-page thesis. This is the capstone exercise of the entire Scuttlebutt process. It is the act of forcing yourself to synthesize all your research into a simple, clear, and powerful document. The goal is to create a one-page summary of your investment thesis that you could explain to an intelligent friend in 5 minutes. Step 1. Write the moat sentence. At the top of the page, you must articulate the company's competitive advantage in a single sentence. For See's Candies, it might be, See's Candies has a multi-generational brand moat built on nostalgia and social ritual, which gives it unshakable customer loyalty and significant pricing power in the boxed chocolate market. This sentence forces you to be precise about the nature of the advantage. Step 2. List the pillar evidence. Below the moat sentence, create 4 bullet points, one for each of the first 4 pillars of Scuttlebutt. For each pillar, write down the single most compelling piece of evidence you uncovered in your research. For the customer pillar, it might be, online forums show customers describe the product as irreplaceable and report panic when they think it might be discontinued. For the competitor pillar, the CEO of the main competitor admitted on an earnings call that they cannot replicate the target company's brand magic. You are summarizing your best clues. Step 3. Articulate the growth narrative. In a short paragraph, explain how the company's moat will allow it to grow its intrinsic value over the next 5 to 10 years. Is it through pricing power? Is it through expanding into new markets? Is it through taking market share from weaker rivals? This section connects the static analysis of the moat to a dynamic vision of the future. It is your story of how value will be created. Step 4. Define the thesis breakers. This is the most important step for avoiding confirmation bias. At the bottom of the page, list 2 or 3 specific events or pieces of data that would prove your thesis wrong. For example, my thesis would be broken if a new technology emerges that makes the core product obsolete. Or, my thesis would be broken if the company's visionary founder retires and the culture of innovation disappears. By writing these down in advance, you are pre-committing to being objective. You now have a checklist. Every quarter when you review the company, you can look at your list of thesis breakers and ask, has any of this happened? This turns the ongoing process of monitoring your investment from a passive activity into an active, disciplined one. This one-page thesis is your intellectual anchor. It is the physical manifestation of your deep research and the source of your conviction. The alternative to this disciplined synthesis is the antithesis, the path of the 99%. This is the path of the fact collector or the data drowner. This person does a lot of research, but they never achieve true understanding. Their desk is piled high with annual reports, their computer has 100 browser tabs open with different financial websites, and they can quote you any metric you want. But they have no coherent story. They have 1,000 data points, but no wisdom. They suffer from analysis paralysis. Because they have no central narrative, every new piece of information, whether it's a minor news story or a meaningless twitch in the stock price, carries equal weight. They are constantly buffeted by the noise of the market. They will hear a positive rumor from one analyst and feel euphoric, then hear a negative comment from a television pundit and feel panicked. Their conviction is a mile wide and an inch deep. Because they have never forced themselves to synthesize their research into a core thesis, they don't know what actually matters. They can't distinguish the signal from the noise. When a real crisis hits, like the American Express salad oil scandal, the fact collector is helpless. They have all the negative data points, the $60 million liability, the collapsing stock price, the panicked headlines. But they have no countervailing narrative about the strength of the brand in the customer's mind to hold on to. They have the facts, but they've missed the truth. They inevitably sell at the point of maximum pessimism, locking in their losses. The failure of the fact collector is a failure of synthesis. They do the work of gathering intelligence, but they skip the final crucial step of weaving it into a usable narrative. This leaves them intellectually and emotionally defenseless against the chaos of the market. True long-term investing success is not about knowing more than everyone else. It's about understanding what you know and why it matters. The direct financial connection of this final pillar is the most important of all. A well-synthesized, scuttlebutt-derived narrative directly enables the two behaviors that are responsible for almost all long-term investment success: concentration and patience. When your understanding of a business is deep and multifaceted, you gain the confidence to make larger, more concentrated investments. Instead of diversifying your capital across 50 different stocks you barely understand, a strategy Buffett calls diversification, you can allocate a meaningful portion of your portfolio to 5 or 10 businesses that you have analyzed with extreme rigor. This is how real wealth is built. The returns from a few big winners will vastly outweigh the results of a broadly diversified portfolio of mediocre ideas. But concentration is only wise if it is born from genuine insight. The Scuttlebutt narrative provides that insight. Secondly, and just as importantly, the narrative is the source of patience. The stock market is a volatile, manic-depressive machine in the short term. Great businesses see their stock prices cut in half for no good reason. The ability to hold on through these periods of gut-wrenching volatility is what allows the magic of compounding to work. The story you have built through your research is what gives you the fortitude to do nothing, to sit on your hands and let the business continue to grow its intrinsic value, knowing that the stock price will eventually catch up with the business reality. This combination of concentration and patience is the holy grail of value investing. It is what separates the amateur from the professional, the speculator from the true business owner. The financial result is a portfolio that is capable of generating market-beating returns over the long run. The process that began with a simple conversation with a customer culminates in a portfolio structure and a psychological temperament that can lead to true financial freedom. This is the ultimate promise of the Scuttlebutt method. Not just to find great stocks, but to build the conviction to hold them and reap the rewards of their long-term success. You have just been given a powerful and timeless mental tool. You've learned that the most valuable information about a business isn't found in a spreadsheet, but in the real world. You now possess the 5-pillar framework of the Scuttlebutt method, the key to understanding a company through the eyes of its customers, its competitors, its suppliers, and its own people, and the wisdom to weave that knowledge into a powerful investment thesis. This isn't just theory. It is a practical blueprint for developing a true informational advantage, for learning to see the economic moat that others miss, and for building the conviction required for genuine long-term success. You have taken a massive step away from the path of the 99% and onto the path of the serious business analyst. But mastering this investigative method, this art of asking the right questions, is only the first half of the equation. It's like learning how to be a world-class detective. You now have the skills to analyze any crime scene. But an even more powerful advantage is knowing exactly what kind of crime scenes to look for. Warren Buffett's system is a network of interconnected mental models. The Scuttlebutt method is the tool he uses to investigate, but the targets of his investigation are a very specific set of business structures, the different types of economic moats. A moat built on a brand, like Coca-Cola's, behaves very differently from a moat built on a network effect, like Facebook's, or a moat built on low-cost production, like Geico's. The video that is now on your screen is the missing link. It is the next piece of the map. It takes the how you have just mastered and connects it to the what. It is the field guide that details the different species of great businesses that exist in the corporate jungle. Understanding these patterns allows you to focus your powerful new investigative skills on the most fertile hunting grounds. You have learned the detective's methods. Now it is time to learn the master criminal's signature moves. The truly elite investor, the one with a complete mental arsenal, doesn't just know how to investigate. They know exactly what to look for. The framework that connects these two halves of the puzzle is waiting for you in the next video. The choice to continue your ascent, to complete this crucial part of your education, is yours. Click and master the other half of the equation.